Guys, that individual retirement account that you own that is ultimately possibly going to be inherited by somebody, what is the taxation going to look like when that person inherits it? Or maybe somebody else owns that IRA that ultimately you're going to inherit. When do you have to pay taxes on it? What does the taxation look like? Let's talk about that a little bit, but let's also discuss trusts. Trusts as beneficiaries on individual retirement accounts. I get the question all the time, Charlie, should I put the individual people, my kids, as the beneficiaries of my IRA, or should I put my revocable trust as beneficiaries of my IRA? Let's discuss this. I'm going to discuss the trust thing last. First, let's jump into taxation. So the most common situation when it comes to individual retirement accounts, that have not been taxed yet, that ultimately need to be taxed, the IRS says so. Here's the most common situation is you have spouses. Me, I own, let's say, $1 million IRA. I pass away and my wife, Noelle, is the beneficiary. What are her options? She's got a few options, but here's what happens 99% of the time. She just continues it as if it's her own. She continues it as if it's her own. The IRS allows for that when it comes to spousal situations, and that's called the spousal continuance, which means she doesn't have to cash it out like other beneficiaries do, non-spousal beneficiaries do. She can just continue it as if it's her own. Now, one thing to keep in mind is this. Eventually, the IRS does tell us all that they want their tax money. What am I talking about? Required minimum distributions. Depending on what year you're born, you have to take required minimum distributions at age 73, or for me, my schedule is age 75 when I have to take RMDs. So eventually my wife's going to have to pay taxes on it, whether she dies and it passes to a beneficiary and they pay taxes then, or she hits RMD age. But that's the most common scenario. The second most common scenario is this: me passing on assets to my kids, for instance. So if the kids are at least 10 years younger than you, which if they're kids of yours, they're probably going to be, right? Just doing the math in my head. If the kids are at least 10 years younger than you, which is a very relevant timeline per the IRS, here's what the IRS says: that from the date that you passed away, your kids have 10 years, have a 10-year rule to where they have to cash out that individual retirement account. So if I die today, my kids have 10 years in which they would cash out that individual retirement account. Technically, it wouldn't be them because they're minors right now, but I'm not going to go into all that. They have 10 years from when I die that they have to cash out that individual retirement account and pay taxes on all of it. Could be 10% per year. It could be all of it up front. It could be all of it in the 9th year, or any mixture of those scenarios. As long as it is completely liquidated, the IRS has all of their tax money by the end of that 9th year. And it is full-blown income taxes. Whatever tax bracket that beneficiary is in, it's income taxes on what that IRA is that they have inherited. Now, here's a question that I get a lot is, what happens if I was old enough that I crossed over my required minimum distribution age, which for me it's 75. For some of you it's age 73 if you were born prior to 1960. Age 73 is when you hit your required distributions that the IRS wants you to start taking your money from your IRA. What if I hit that, then I pass away? Between years 1 and 10, do my kids have to pay those required minimum distributions? Continue the cycle that I was on when I passed away? The answer to that question is yes. They do have to pay RMDs, required minimum distributions, between years 1 and 9, and just make sure it's all cashed out by the end of year 10. So those are the most common situations with individual retirement accounts. Just understand that somebody's going to pay income taxes on the value that has not been taxed at some point in time. Now, trusts. I'm going to say this first, that generally revocable trusts, irrevocable trusts as well, that generally it usually does not make sense for a trust to be the beneficiary of an individual retirement account. It can actually be detrimental sometimes. So let me explain. First and foremost, a revocable trust does a beautiful thing. It avoids probate, right? Which is a very expensive process for your estate, and it's also a very cumbersome, lengthy process in many cases. Well, the fact that IRAs have beneficiaries, that if you name a person as a beneficiary, that avoids probate as it is. That can kind of offset the benefit of putting a trust as a beneficiary. Furthermore, when you have a trust as a beneficiary, many times that trust can have a 5-year rule when it comes to taxation. Remember how I said that the kids had 10 years? Somebody that is more than 10 years younger than the person that passes away, they have 10 years to cash it out. Trusts, unless they're a certain type of trust, a see-through trust it's called, which I won't go into, they actually have an accelerated taxation requirement versus if it were individual people named as the beneficiaries. So by putting individual people as the beneficiaries, one, you are avoiding probate because that's what beneficiaries do, whether it's on a life insurance policy, an annuity, or an individual retirement account. You avoid probate. But number two, by having them named individually, especially if it's a spousal situation, having that spouse as a beneficiary, that affords her the spousal continuance I talked about, right? So what are you really achieving by having the trust as a beneficiary? Now here's an exception. You may want the trust as a beneficiary if the beneficiary of the trust maybe has, spendthrift issues, not good with money, maybe has drug issues or something like that. Then the benefit of that structured distribution to the trust beneficiary may be more than an offsetting benefit to the fact that there's an accelerated taxation structure. So it's a little bit about trade-offs, but for the most part, usually trusts are not good to be beneficiaries on an individual retirement account.